Back with the market right here in ET now. While we've managed to defend that 24K mark, get ready for some mid-afternoon volatility and chop and churn, perhaps 113 points lower for the Nifty futures as we speak right now. Interglobe Aviation, there's Maruti, HDFC Bank, Eternal, L&T. These are key pressure points in trade. Other than that, of course, there's ICICI GI, which is now knocking down over 4.5%. BDL, which is down 3%. Angel One, which is down 2.5%. Biocon is down about 2.25%. And then HDFC AMC as well, which is lower by about 2%. These are, of course, your top F&O losers. On the flip side, look at the TCS. It's scaling up further, 2.6% higher for TCS right now. Adani Green, Voltas, BHEL, and then, of course, Kalyan Jewellers sitting right on top with that near about 5% off a move. But let's welcome on board Rahul Kanodia, VC and CEO at Datamatics, and ask them about what's happening in their business. Rahul, great to have you on ET now. Help us quantify this deal that you've struck. What exactly is the contract value, the implementation timeline, and of course the expected revenue recognition as you see it over the life of engagement?
Yeah, so, since we just finished the quarter end, we are in the silent period, and therefore it's difficult to give you numbers. But broadly, I can tell you that this is on the Salesforce side. When we acquired Dexara, we were typical deals were sub $100,000. Now we've got several deals that are in the range of $500,000 to $2 million each. We signed some, and there's quite a few more in the pipeline. So the deal sizes have increased substantially, and therefore we're looking at a very optimistic future for this Dexara acquisition in Salesforce. But this specific deal, because of the silent period, I don't think I would be able to specifically give you numbers. But it's a very good deal.
And is this a one-time Salesforce implementation, or does it include recurring revenues through managed services, support, AI enhancements, or future platform expansion? Can you give us some color around that?
Both. So it is a one-time thing, and it will continue with the managed services, and then there'll be add-on modules around AI and things like that. So it's a combination of both.
Morning, Rahul. How strategic is this client for Datamatics, and could this engagement lead to additional opportunities across other business units as well, or geographies, or digital transformation services?
Absolutely. Our thrust is around AI, and one of the focus areas is transport. So this customer is in that space of transport and using a lot of AI. So it falls squarely into our sweet spot. It is important because that's our focus area, and it's an important customer, on the back of which, of course, we will grow not only in this account, but several other companies in the logistics space. So in that sense, it's a strategic win.
But how does this win compare with your typical Salesforce engagements in terms of deal size, margins, profitability, and what does it indicate about your pipeline in the transportation as well as the logistics vertical?
So the pipeline in the logistics vertical is just becoming stronger as we are focusing on that, and we are getting more and more wins. This is on the higher end. I gave you the range. So this is at the higher end of that range, which is very good. It's a multi-year deal, and I think it all goes very well. Outside of this, we have been focusing on AI generally, as you know. We also launched an agentic AI underwriting solution, and since then we've got a few more deals under our belt. So that's also looking very positive for us, and it's getting good traction in the market, particularly the Western market.
And how much of this is AI-linked revenue? Would such deals typically be fixed-price contracts or time-based? Could you give us a sense?
So we have implemented AI into a finance transformation platform called Finato. We also launched the agentic underwriting platform, and now we are in the process of building an agentic AI claims processing platform as well. All these deals are getting us multi-million-dollar deals, and these are multi-year deals. So they're all very good, completely on the AI platform. and customers are responding extremely well to whatever they've seen coming from the Datamatics table.
Since you sound very bullish, does this enable you to hike your FY27 growth guidance from a high single digit, which you have guided for an organic growth?
We still have to see because we just launched it about 6 months ago. We've got a few logos under our belt, a few more coming in. They will always start small, although it's a multi-year, multi-million-dollar deal. It starts very small and then grows. So I would take that call maybe another 1 quarter down the road, perhaps once we see these doing very well. So right now, I would stay with my current projections. But yes, in a quarter, we would be able to revisit. Generally, one does see that the market is a little soft. However, because of these AI platforms, our conversion ratios have increased and improved quite a bit. So we will be converting more deals, but the market is a little softer than what it was 2 years ago.
Rahul, but are you seeing efficiencies from AI on your output as well? And how much is AI-linked efficiency currently, if you could just quantify that? And are you passing this on to the clients too?
These deals are purely AI, and AI is forming a crucial part to your earlier question, which I didn't answer, is that these are all output-based deals. So per transaction, per claim processed, or per invoice processed, or per offer underwritten. So all of these are output-based or outcome-based. Since they're all AI-driven, we are in the process of both sharing the gains with the customer and ourselves. So we are improving our own margins, plus at the same time, we are sharing some gains with the customer. So both of us stand to gain. And that's really when you have a win-win strategy, when the customer also gains and we also gain. And that's very important to be successful in the market.
Okay, Saurabh, with that, we'll wrap this conversation up. Thank you so much for joining us and giving us that perspective. Datamatics, of course, that's the management. But the street continues to stay cautious on Indian IT. Top global brokerages believe valuation concerns, AI-related disruptions, and slowing growth could keep the sector under pressure, with domestic cyclicals emerging as the preferred bet. Listen in.
So there is a possibility of some technical bounce in the IT service sector. I will not rule that out. But if I take a slightly longer term view of 6 months or 12 months, I would still stay away from that sector because it is, at the end of the day, a single digit EPS growth sector. And I don't think that is really going to change, over the next, 1 to 2 years, at least. So my sense is that, yes, the stocks have got derated, but I think that derating is fully justified. And I won't rule out, further derating. But even if not, and even if one assumes that the multiples will sustain at the current level, but then the returns will be in line with the EPS growth, which is in single digits and not really that attractive.
With the IT, there are still, I guess, concerns around whether how much disruption would there be to the business models. And when I say IT, I think it's the broader IT, both in US as well as in India. But many of the clients we speak to, they still point to the fact that many of the US peers for the Indian IT companies, they are still trading at much cheaper multiples than Indian software companies. And if you're actually looking at local macro and corporate earnings recovery, we think the domestic cyclical pockets do much better than IT.
This is more negative on, you can say, a medium term to long term perspective, because growth has been slowing down in the IT space. If you look at over the last 10-15 years, revenue growth has come down to 2-3% kind of a trajectory. Your earning growth is also declining. So we don't know what is going to be the terminal P for this sector, whether it will be 24, 20, 15, or maybe it will be a 9-10 P kind of a sector, which is an X-growth sector.
Okay, that's the view on IT from market bigwigs. But let's take stock of what's happening in the trade today. Just dial, that's the big buzzer in trade. Why so? Ashesha is here with the analysis.
Stock is soaring in trade today, up more than 10% the last time I checked, and two separate reasons. One, of course, is the strong set of numbers that it reported for first quarter of FY27, and second is new appointment that they've done in the management. And remember, he is an ex-Flipkart executive, so two separate news pieces. First, let's talk about earnings, where on a sequential basis, revenues have grown by about 10%. Margins have softened a tad bit, but despite that, the top line growth has been very strong. Other than that, the operational metrics also reported are also very strong on a year-on-year basis. So we have quarterly unique visitors that rebounded by about 6% on a sequential basis. Mobile traffic also rose 7% QOQ. And other than that, active listings rose by about 3% on a sequential basis. So numbers were strong, but most importantly, the operational numbers have been very strong this time around. Other than that, the cash balance continues to remain very solid, much more than the market cap of the company. So the current cash balance stands at about 6,022 crores, and this has risen substantially from about 4,755 crores that the company had reported in first quarter of FY25. So over a period of last several quarters, the cash balance clearly has strengthened substantially. Other than that, as I mentioned, there has been some management appointment as well, where the company has said that they have appointed a former Flipkart executive, Dinkar Alilyanpuru. He was previously heading the wholesale arm of Flipkart, and he has spent about 15 years at Bain Capital, and he has more than 2 decades of experience in building, transforming and scaling businesses across digital commerce and retail. So strong management appointment that has happened, and that is also one of the reasons the stock is soaring in trade today.
Sesha, for that, meanwhile, there's one sector which is buzzing ahead of the big IPO which is opening tomorrow. SBI Fund Management's IPO is coming out tomorrow, and we're seeing Canara Robeco, UTI AMC, Aditya Birla AMC, Nippon, and ICICI Pru, active in today's trade. While there is some correction coming in SGFC, AMC, and IL. That's only one which is having a valuation higher than SBI mutual fund at this point in time. But again, Ashesha joins us with Goldman Sachs, which has come out with this report on India. The brokerage firm has set June 2027 as Nifty target at 26,500. Ashesha, what do we have?
Yes, so 26,500, that's the Nifty target for June 2027, and this implies nearly 10% upside from the current levels that we are currently at. Now, they're saying that the outlook has improved on account of several factors. One, of course, is lower commodity prices in the global market. Second is stable currency. Third is resilient domestic growth and healthy expectations from the second quarter earnings season. These are the 4 factors which they believe are very positive, and that will likely aid the 10% upside on the Nifty going forward. They're saying ultralight foreign positioning is providing ample room for foreign institutional flows to return back into Indian equity markets. They expect rotation from growth to value and from mid caps to large caps as earnings recovery broadens, especially after first quarter FY27 earnings season. Key themes to watch out for: one is banks, other is tourism, and also energy refiners. These are their long-term trades. They say that they've raised their their ranking on utilities to overweight. Exporters and select materials have been downgraded to underweight. Super El Nino is seen as a headwind for rural stocks, but it is a catalyst for power utility, especially because they are facing shortages at a time like this. So yes, they're very bullish on Indian equity markets, at least for the next 1 year. 26,500 is their target price, implying 10% upside from the current market price.
Yeah, Shisha, we'll leave it at that. In fact, let's get Mitali on board and find out how Fino Payments Bank quarterly update was.
Right, so if you see Fino Payment Bank, that stock is surging in green today, above 9 to 10% in today's trading session. So company has reported a very strong update, the business update for June 2026. And if you see, it is led by healthy deposit growth, robust customer acquisition, as well as sharp rise seen in their business, the loan referral business. The average deposits, they have increased nearly 11% on a yearly basis, while the bank added 3.1 lakh new accounts during the month, which is up 31% on a yearly basis. Digital engagement, it also remains strong for the company. Digital active customers, they rose 22%, while the FinoPay active users, there also an increase of 38% has been identified. The key highlight was the loan referral business, where disbursals have surged nearly 253%. Year on year to 240 odd crore rupees. This strong growth supports Fino's proposed transition into a small finance bank and also highlights the lending potential on its existing customer base. On the payment side, the throughput, it declined 35% to 2,830 odd crore rupees, reflecting the continued shift from the cash-based transactions to now UPI. However, the pace of decline, it moderated as compared to the previous month as the bank focuses on improving the merchant quality as well as the transaction productivity. Renewal income also saw an increase of nearly 6% yearly. So overall, for the bank, the business update, it showed strong deposit growth, rising digital engagement and rapid expansion in its loan referral business, while the decline in throughput as well as the progress on the small finance bank transition, that remains the key factors to watch. Back to you.
Okay, thank you so much for that, Mithali. Let me go across to Snehi. She's here with a roundup with regard to Avenue Supermart's in-line set of Q1 numbers. All street metrics largely meeting street expectations, except probably top line. Snehi here with the number crunching.
Well, yes, so just taking a quick look at the standalone numbers coming in from D-Mart or Avenue Supermarts as we formally know it for Q1, all numbers largely in line. The margins have come in at 8.3% compared to 8.2% on a year-on-year basis, and this is despite about a 30% hike in the employee cost. So looking good in terms of the resilience that we've seen on the margins, but there has been a moderation when it comes to the like-for-like growth for the company, because remember in the previous quarter, this number was north of 10% and it's come in at just 5.5% this time around. So very sharp cut, but largely this was priced in by the estimate, and this is largely what the street was already estimating. If I take a look at what the store addition trend has been, only 3 stores have been added in the first quarter, and the expectation was at least 9 stores would be added, so a big miss on that front, and this is their slowest quarterly store addition in the last 12 quarters or in the last 3 years, so that's quite a significant slowdown. The management has said that stores in large metros, they have where the revenue is higher, the growth has been slightly slower, but stores in non-metros are showing very good same-store sales growth. They continue to deepen their focus in large metro cities while improving their D-Mart ready business. They've consolidated the business to just 11 cities now. This business was available in 18 cities. It's been shut in 7 cities in the quarter gone by and is now available only in 11 cities. Taking a look at what the brokerages are making of these numbers, Axis Capital has maintained its ad rating, but the target price has been moderated to 4,650 all the way from 5,050 rupees, so cut over there. Jefferies, Bernstein, Morgan Stanley and CLSA have all maintained their ratings as well as their target price, and in fact Systematics and Motilal Oswal have maintained their ratings but have hiked their target prices respectively. MK says that slow TAM expansion, fading USP of value growth and assortment versus quick commerce, the deteriorating return on investment capital and expensive valuation are all denting this stock, and Elara also believes that bills per store have declined 4.4% on a year-on-year basis despite a 1.5% increase in the average selling price. So this indicates a sharper mid to high single-digit volume drop in metros. So these are some of the reasons why the stock is under pressure despite the numbers being largely in line with street estimates.
Thank you, Sneha, for that update on Avenue Supermart after the numbers which have come in. But moving to another platform company, Swiggy is under pressure as food safety regulator FSSAI has issued 9 notices to Swiggy Instamart following multiple consumer complaints over alleged delivery of expired and spoiled and contaminated food products. The regulator has sought a detailed compliance report warning that the failure to respond satisfactorily could invite legal actions against the food under the Food Safety and Standards Act. My colleague Kuldeep has more details.
Well, the Food Safety and Standards Authority of India has issued 9 notices to Swiggy Instamart following the complaints of various consumers that unsafe food being sold through the platform. As per the consumers, as per the complaints, the Swiggy Instamart supplied expired food products or rotten food products to multiple consumers, and there have been a lot of complaints which were raised over social media, and following that the FSSAI has issued notices to Swiggy. In the notices, the FSSI has demanded that Swiggy must submit a detailed explanation supported by documentary evidence addressing the alleged non-compliances and circumstances leading to the reported incidents. The FSSI also sought details of quality assurance, food safety monitoring, inventory management, stock rotation, hygiene, storage, handling practices, and internal controls adopted to ensure food safety compliance. Well, this is not the first notice that has been issued to Swiggy Instamart. In fact, 2 days before, the FSSI had issued notice to Swiggy over towing platform. There were some issues related to the licensing with respect to towing platform, and on that matter, a notice was issued to Swiggy Instamart because towing is a subsidiary of Swiggy. Well, in its response to the latest notices of FSSI, Swiggy has stated that they have been reviewing all the notices, and they will accordingly, they are in touch with the officials and they will accordingly take necessary action.
Okay, interesting, Kuldeep. Thanks very much for those details. In fact, on that note, we're going to wind it up right here in this edition of First Trades and the Market. Thanks for watching.
Hi there, good morning. You're catching us live from the Suzlon studio here at ET Now. This is Midcap Masala and I am Snehi Shah. This is a show where we're going to be diving deeper into the broader end of the market, give you a finer sense of what's happening in the nifty mid-cap and small-cap space. Before we take you through what's happening at the index level, here are some of the top stock buzzers from that space. Let's start by talking about the earnings candidate Just Dial. That one is trading higher, gains of about 13.25%. So a big gainer in trade today after reporting a very healthy Q1 revenue growth of 10% on a year-on-year basis to 327 crore rupees, supported by strong platform activity and advertiser monetization, while the net profit rose 4% on a year-on-year basis, aided by higher other income. The company also reported its fastest sequential listings growth in a decade, and the company has appointed Dinkar Ailavarapu as the CEO designate, all positive for the stock, and the stock is seeing gains of about 13.25%. Shifting focus then, talking about another high flyer, that's Fino Payments Bank, after reporting a strong June business update with average deposits rising 11% on a year-on-year basis, new account additions up 31% year-on-year, and loan referrals disbursals surging to 53% on a year-on-year basis. That's almost triple. The update also highlighted robust digital customer growth and continued progress towards its proposed small finance bank transition. Stock is up 9% as we speak. Shifting focus then, Good Luck India is also trading higher after its board approved a 2:1 bonus issue. The company also highlighted a robust defense order book of 255 crore rupees and expects the sector to be a key growth driver going forward. Stock up 3%. And the management that we spoke with earlier in the day, Lux Industries, is trading higher after announcing a 600 crore rupee investment to set up a new manufacturing facility in Dankuni, which is in West Bengal, which will increase its total production capacity to 36 crore pieces annually. The management also told ET Now that the new 14 to 15 crore piece capacity will be commissioned in phases over the next 5 to 6 years, with the first phase becoming operational in 2 to 3 years. That stock is up with gains of about 2%. And shifting focus then, Idea Forge Technology is also trading higher after successfully raising 500 crore rupees through a qualified institutions placement, issuing 62.9 lakh shares at 795 rupees per share. The fundraise is expected to strengthen the company's balance sheet and support growth initiatives amid rising opportunities in the defense and drone sector, 1.25% uptick coming in on that stock. While that is at a stock-specific level, just taking a look at what the index is doing right now, we started on a slightly shaky note when it came to our markets in the morning. We've seen a little bit of an uptick coming in from the session's low. 0.2% of a cut is what we're seeing, but we're above the 24,100 mark as we speak. The broader end also is looking quite mixed because Nifty small cap is up 0.2%, but it's the mid cap index that's seeing cuts of about 0.1%. So very flattish moves coming in. But yes, we've seen a good recovery coming in both on the mid cap as well as the small cap indexes today. Now, while that's on the index level and about all the stocks that we've spoken to you about, let's refocus and dive straight into the corporate conversations that we've got lined up for you. We've got Mr. Ravi Jhakar, the Director of Strategy and Group CFO at All Cargo Group, and very interesting to speak to this company right now in terms of their outlook as well as the outlook on the sector with everything that's happening on the geopolitical front. Opportune time to be speaking with you. So thank you so much for your time today, Mr. Jhakar, and good to be speaking with you. Let's start by talking about the company and your outlook going ahead. You've guided EBITDA to profit before tax to grow ahead of revenue in FY27. If you don't mind, can you put a number on the margin target you're working towards?
So, Snehi, pleasure to be on your show. If I can just put in context, we're talking about a group structure here which has been going through a massive reorganization over the last 4 years, which has now come to a conclusion with the listing of All Cargo Global, which is our flagship international supply chain business. So it got listed about 10 days ago. So now we have 4 companies, each one focusing on a specific business. And that provides a lot of clarity to investors and also brings in sharper management focus. So that's something which is the most important milestone for the group, which got concluded about 10 days ago. Now, on the main flagship business, All Cargo Global, we had been witnessing extremely strong headwinds in terms of the geopolitical environments, tariff barriers, trade environment being very tough, I would say over the last 12 to 18 months. We feel that we have seen the bottom towards the close of the last calendar year. And since then, we have seen marginal improvement in terms of the business momentum. And going forward, of course, it depends on how the geopolitical environment continues to evolve. But we believe that from here, there should be a gradual recovery in the overall global operating environment as far as trade is concerned. But what is important to note from the company's standpoint, and that's where I'm coming to your point on margins, for the last financial year, our revenues dropped from about 14,000 crores, roughly about 10% from those levels. But we were still able to bring in, sharper focus on operational mix, the trade lanes, the right kind of, container utilization, and a lot of other initiatives, because of which we were able to increase the gross profit despite a dip in revenue. And it was a healthy more than 2,750 crores of gross profit. And the biggest cost for us in this business has been the SG&A costs. And the developments that we have seen over the last 12 months in technology really open up new opportunities for us, because things which were slightly complex and required human involvement, and given an international business, that's a big part of our cost. We are now able to find opportunities to downsize the cost of operating for every cubic meter of cargo that we handle, which means that we can continue to grow at a more tighter operational control, which means that the margins should expand. So that's something which, sequentially we are witnessing. Of course, a stronger business environment would add tailwinds to that. But at this point in time, we believe that that's the trend which should continue with some momentum on margins expanding. And there were a lot of one-off, reorganizations last year as well. So I think next 4 weeks, we should be publishing the quarterly numbers for the global business. And that should give a good sense of where we stand on the global business and how it looks like going forward. On the domestic side of the business, again, the story is quite similar. We saw a growth in revenue as well as a very robust growth in EBITDA. EBITDA for the year grew by almost 14% last year. But more interestingly, for the last quarter, it was 40% year-on-year growth. And that's, again, a story of the turnaround in the domestic express business, being done. And from there on, the business environment in India has anyways been strong. The domestic consumption-led logistics growth has remained strong for last, I would say, at least 4 to 5 quarters, and the momentum remains similar. So we expect that in the domestic business, which is operated in all cargo logistics, we should also continue to see, a flatter cost base with rising revenue, and that means that we can possibly see the margin expansion. I would refrain from putting specific guidance to that, but we have provided 3-year guidance across all the 3 businesses, these 2 as well as our ICD CFS business, which is under all cargo terminals. And we believe that the businesses are more or less align to those targets
Okay.
as we move forward.
Okay, understood. So now that the integration is already done, we're going to start seeing the benefits and some steadiness in the quarters to come. But Mr. Thakur also talked to us about how are the freight volumes shaping up? What would your outlook be on global freight volumes, given the disruptions that we're once again seeing on the West Asia front? There is so much back and forth in terms of the opening and closure of the Strait of Hormuz. How are you reading through, and how would you plan to navigate through the turmoil that we're seeing in the sector?
So there has clearly been a disruption, and that continues to remain that way as far as the Middle East is concerned. But there's also been a stronger momentum on, let's say, Asia to Latin America trade. There's also been some degree of renewed momentum on the trans-Pacific and both transatlantic trade as well. So what we are witnessing is that on one hand, there remains a volume shortfall on the Middle East trade, but we also see volumes picking up on the other trade routes. And therefore, at a global level, we feel that at least on a quarter-on-quarter basis, if you look at the last 6 months since the war, there has been slightly positive momentum. And that's also reflecting in the higher freight rates that we see across a lot of trade lanes. I believe that these freight rates should possibly stabilize over the next 4 to 5 weeks and then, be around those levels. We don't see these continuing to spike up. But like I said, in summary, there's a issue in the Middle East. But on the global basis, overall, there's a slight positive momentum on the volume side and even more on the freight rates.
Okay, that's interesting to know. And Mr. Thakur, if you can help us understand, how has the PM Gati Shakti initiative and dedicated freight corridors changed logistics efficiency in India? Just give us a broad sense of that as well.
So I think, dedicated freight corridors bring in more efficient rail transit into play. We had been waiting for the Delhi-Mumbai freight corridor to be fully completed, which is now near completion with some of the last, leg of the connectivity to JNPT also coming into play. At All Cargo, we are in fact building up a very meaningful infrastructure in NCR in the All Cargo Terminals business, which is our inland container depot at Farrukhnagar, which connects to the dedicated freight corridor. And we believe that it will improve the transit time. And of course, I don't see the near-term impact of the other freight corridors which have been announced. But once we have multiple other freight corridors also completed, we should see faster transit of cargo, lower cost of handling as well. And I think that's something which should be one of the enablers for the Indian economic growth. On the PM Gati Shakti terminal as well, we are seeing a lot of investments coming in from the government as well. In terms of enabling private sector to be able to set up these terminals by providing the requisite land, connectivity, and the basic infrastructure with multiple multimodal logistics parks being, put up for auction. We have also seen various freight terminals being also put up to tendering as well. So I feel that over the next 5 to 7 years, we should see more and more such terminals coming up. We should provide for better multimodal connectivity, and it would provide the much needed movement for the trade, because for the economy to grow, the trade has to be very efficient and smooth. And the combination of freight corridors on one hand and much improved road infrastructure on the other means that India can continue to grow at a high single digit as far as the domestic economy is concerned. So I think they play a very important role on the economic growth.
Right. Thanks for putting that down so wonderfully for us. Mr. Thakur, the other concern is on the pricing front. We've seen freight rates gone up. We've also seen Brent now that has once again spiked. So you've got crude prices also that are now on the upside. Talk to us about how you're looking at pricing for your company as well as for the industry. What is going to be the rate of the pricing pass through, and when would that happen in your view?
So as far as the international shipping is concerned, we have seen that while there is an impact of, bunker costs, we have generally seen over the last, if you look at a longer 10-year window, the greater impact on freight rates comes from the demand supply dynamics more than the crude pricing. So there, the impact of crude per se is limited. It's more of the temporary demand supply situation. On the domestic front, naturally, fuel costs are a large part of our operating costs. But I think on that front, again, the government has been very supportive to the businesses by ensuring that the increase in fuel costs has been limited. So I believe that, the overall environment is moving more towards peace, even though, of course, there are, daily ups and downs in terms of the news on the war. But I personally believe that we are moving towards stably lower crude price levels, and with the government's outlook of not passing on the entire cost, which is what at least it seems to be now, I think the impact can be controlled. But there is certainly a slight impact on the domestic logistics cost for us on the fuel cost rise. So we really hope that the war comes to an end, and then we are not under any pressure. And the government also is not under any pressure to subsidize those costs.
Okay, so that we're going to be making a note of that on the pricing front. Mr. Thakur, lastly, with warehouse capacity expansion now going asset light via operating leases, how does that change your own capex guidance and return ratios for FY27? Any incremental change in that guidance?
On the all cargo logistics business, where we operate the warehouses and contract logistics business, we do not have any material capex requirements. All the warehouses are on operating lease. Even our truck fleet is entirely from our vendor partners. So while we run and operate the network and we run and operate our warehouses, we do not make any capex towards that, barring some equipment here or there. So overall, the business will continue to be extremely asset light, with investments being a very small part of the cash flow generated. So I would say almost a near minimal capex for the all cargo logistics business, and the same story is for all cargo global business as well.
Understood. So yes, that sounds really good. No incremental substantial capex requirements. That's the takeaway from this conversation. Mr. Thakur, thank you so much for your time today, and thank you for throwing a light on what's happening within the company as well as the overall sector, given that there is so much turmoil on the geopolitical front. Once again, thanks so much for your time.
Thanks, it's my pleasure.
Thank you so much. Okay, viewers, then shifting from one management to the other, we've got Mr. Ajay Kejriwal, the Executive Director of Choice International Limited, joining us on the show. The international arm of Choice has gone ahead and struck an investment deal. Let's decode that and understand what the outlook is over here. Mr. Kejriwal, hi, morning. Thanks for your time today. Let's talk about this. Let's talk about this 900 crore rupee investment by NHIS. How much of this is earmarked for the MTF funding, technology development, customer acquisition, institutional broking, or other initiatives? Can you give us a split of where this investment is going to be deployed?
So, Snehi, the 900 crore which we are supposed to get it is earmarked to the broking and distribution business. As of now, we have not specified any particular amount to any particular, like MTF, how much we have to grow, and how much will go to the technology and enhancement of the infrastructure, AI-led research. But broadly, it will go into all these activities. And of course, the primary object is to grow the MTF book, which is the current scenario going in the industry very rapid for the earnings also.
Understood. So that's the priority right now. Mr. Kejriwal, can you talk to us about the deployment period? Any timeline by when the capital will be deployed, or any phases in which this capital is going to be deployed?
Yeah, so we have applied for the regulatory approval, and we expect the regulatory approval in the next 1 month, and the whole money will be deployed, will arrive in the company after immediately the approval. Now, as and when we grow the business, it is lying with the company and it will be deployed immediately. So there is no phase-wise incoming of the money.
You're not looking at any hurdles to acquire that approval, right? It's expected to be an easy approval?
Yeah, it's normally there is no anything special in the approval. It is a get through, only the process time, whatever it takes, it's the only that matter.
Okay. And now that this 900 crore rupee investment is going to be trickling in into the company, can you give us a sense of how this translates into your financials, how this is going to be aiding your top and bottom line?
Yeah, so we see in the next 3 years, our broking and distribution business to grow year from year at least 5x time.
5x, that's a big number, and that's a number that you've shared with the street as well. It has got, the market excited about the kind of growth guidances that you have. So here's looking forward to that 5x number. And, so much more to talk about that. But let's talk about the Demat accounts right now. Choice already has about 1.26 million Demat accounts, if I'm not wrong. But out of that, the percentage of active accounts is quite small. What is your target for active client penetration over the next 2 to 3 years? And how much of this 5x growth assumption depends on increasing activity among existing clients versus the clients that you will be focusing on acquiring newly?
Okay. So if whatever you have showed the active account and total demat account, it is the industry-wide practice. The active ratio is almost more or less similar, and we are in line with the industry. Looking to the growth of the next 3 years, of course, the new additions, new acquisitions will be there in the same almost 3 to 4 times the addition will be there, which will be more triggered through the technology expansion and AI-led research and experience given to the customers. So that will help us to bring in more customers, their broking business, their routine weekly funding business, and the MTF book. So that will add cumulatively in the all. Secondly, we have the distribution business also, where we are in the wealth management and the bond distribution. There also this fund will be used, which will enhance our additional revenue and bottom line.
Okay, understood. Thanks for that clarity. Mr. Kejriwal, if you can just give us a number on what the current MDF book is looking like, what's the blended yield, what's going to be the funding cost, and after this infusion, how large can the MTF book become without depressing the consolidated return on equity?
So the current MTF book is around 400 crore of the choice equity, and we are targeting next 3 years around to reach up to 5,000 crore, the MTF book.
Okay, understood. Let's talk about the bottom line. Choice has compounded PAT at roughly 70% over FY21 to 26. Now going ahead on the back of this infusion and as the base becomes larger, what would be a sustainable PAT growth rate for, let's say, the next 2 to 3 years, and which segments do you believe will contribute the biggest?
So at the consolidated level, the currently broking and distribution is around contributing 55 to 60%. And going forward, since this money is coming to the broking distribution business, of course, it will in shorter term, it will boost their contribution. But along with this, the other businesses of Choice International, like NBFC is there, government consulting is there, investment banking is there, all has a huge growth potential and orders in pipeline. So that will, along with it, it will grow, and we maintain the trajectory of around 70 to 80%, which will go up to 3 to 4x growth in the next 3 years.
Okay, 5x growth going ahead, 3 to 4x growth in the near future is what you're penciling in. So that sounds good. And, let's talk about the IPO mandates. You've ended FY26 with 34 ongoing IPO mandates that represent roughly 7,550 crores of tentative fundraising, if I'm not wrong. Can you provide a waterfall of this pipeline, and what proportion do you realistically expect to translate into the completed transactions over, let's say, FY27 and FY28?
So we see this, or whatever mandates are there, in the next 2 years, we will execute all the transactions.
Okay, all of them. So this entire 7,550 crore rupee pipeline that you have is going to be transacted in the next 2 to 3 years.
Yes.
Okay, so that sounds good. And, going ahead, I'm just trying to understand a little bit better now that an infusion to the extent of 900 crore rupees is going to be seeping into the broking business. Can you give us a sense of what some more numbers in the business are going to be? We've briefly touched about on the top line and the bottom line. Can you give us a little bit more details on some of the metrics that we should be watching out for?
So currently, we have 500 crore of the top line in the broking and distribution business. As I told, we are targeting in the next 3 years 5x growth, and the bottom line is around 120. So we are targeting more than 600 crore of the bottom line.
Okay, that sounds really good, Mr. Kejriwal. On that note, thank you so much for your time, and excited to see how this infusion, translates into the top and bottom line going ahead, and hope to catch you in conversation very soon once again. Thank you so much.
Thank you.
Thank you. Okay, viewers, then shifting focus then, we've spoken to two managements on the show, but let's also bring you some more news and updates. The Finance Ministry is stepping up its review of the financial sector's preparedness amid ongoing uncertainty in West Asia. Sources tell ET now that Finance Minister Nirmala Sitharaman will chair a meeting with public sector banks and other financial institutions today to assess the potential fallout from the geopolitical crisis. Prakash is joining us with more of those details. Prakash.
Well, the Finance Minister will chair an important meeting with public sector banks and other financial institutions to review the measures announced by the Finance Ministry to mitigate the impact of the West Asia crisis. You are aware of the fact that the Finance Ministry has already announced rupees 2.5 lakh crore emergency credit line guarantee scheme to support sectors affected by the West Asia crisis. And therefore, the Finance Minister will review the impact of these measures on these sectors, a very significant development coming in at this point in time. In fact, we have learned that the Finance Minister may review the status of foreign currency non-resident bank deposits, overseas foreign currency borrowings, and external commercial borrowings, which are important to strengthen banks' funding base and attract overseas capital amid rising credit demand. In fact, Indian banking system has witnessed sustained sustained credit demand in recent years, while deposit growth is muted or relatively slower. Therefore, efforts are being made to diversify the capital base, a very crucial development. In fact, higher foreign currency non-resident bank deposits would strengthen banks' foreign currency resources, improve liquidity support, and countries' foreign exchange reserves. In addition to that, issues related to Mythos AI and banks' preparedness are likely to be on the agenda as well.
Okay, Prakash, thanks so much for taking us through that. So yes, we are going to be watching out for this meeting to be chaired by FM Sitaraman later today, and we'll bring in Prakash once again to bring us all the updates of whatever's transpired in that meeting later in the day. But on that note, we're completely timed out on this edition of Midcap Masala. Thanks so much for watching, but keep watching ET Now, because Buy Now Sell Now is up next.